Now, there is a very interesting story behind it. Once I had the privilege of sitting with some of the IFRS members who had come to India. And that time I was the member of IFRS committee. And the points which were raised were, I was a very layman student of IFRS compared to them. So I asked them, why do you want to change to SOFP? That is statement of financial position. So they told me, Mr. Bhave, do you know what is meant by balance sheet? And then I recollected an event. A balance sheet is a sheet containing the balances from general ledger. All right. Now please, my spellings are not always correct. So let me correct the spelling. Because if it is the original spelling, then it will be Satyam Shivam Sundaram. All right. So sheet containing the balances from general ledger. And then somebody asked me, are the balance sheet, who is the customer of balance sheet? Shareholders, investors. Do the shareholders want to see the sheet? I mean, SHEET. Or do they want to see what? And the answer is financial position. Financial position. And that's where we have made the name as SOFP. Quite correct. Well understood. But our friends who have framed Ind AS, they want to have the word balance sheet only. I personally don't understand. I am open for learning. But currently, IFRS goes for statement of financial position and the Ind AS continues to stick to the word balance sheet. In a way, it is good for us because the more the regional issues we create, all the accountants in this country will have a job. So my recommendation is, do raise the regional issues and do raise even regional non-issues. Now currently a lot of people are raising a lot of non-issues. That's a part of life. Current and non-current assets we talked about. Equity. Equity, currently we know equity means equity share capital. But now equity means net worth, net assets. Equity means net assets under IFRS. And not equity share capital. Now my question here is that if equity is net asset, one day somebody asked me a question, is income more important or wealth? What's more important? And the answer comes fact, wealth is more important. But the funny part is, whenever you will see any company's balance sheet and P&L, the first thing we go and check is the profit and the dividend. Why does this happen? If wealth is more than income, more important than income, why do we look into income and profit? That's the question mark. And therefore, IFRS body says, wealth is important, look at the balance sheet first. Therefore, all the provisions of IFRS have been made balance sheet oriented. Balance sheet over P&L. Balance sheet is more important than P&L. Wealth is more important than income. Preference shares is a liability. Just because the dividend is not allowed as a tax deduction, it cannot be called as a share capital. So preference shares, no more a share capital. Another interesting point, and today again I was reading into the numerous amendments or clarifications which are coming on revised schedule 6. Minority interest or non-controlling interest. Let's dwell upon something more about it. The concept of minority interest continues in Indian standards, and IFRS comes up with the concept of non-controlling interest. Now, this takes us to the discussion on what is control. And most of you will not understand it because just another statistics which have been given, that out of the 2,300, some 15 or 17 people which are seeing this program, out of that more than 1,500 are unmarried. How many of you are married here in Chembur? Only one person. Look at this. Only one person is married here. Only married people can understand what is control. Right? Especially the gents, the husbands. Can you tell me husbands are controlled by whom? The answer is obvious. Why do you think Darais runs to Surat every time? Okay. Because that is his wife's place and he has no choice. So, IFRS has very well understood what is control. And they say that not the person who is putting investment should be consolidating. Who is holding company and who is subsidiary company. Our past impression was holding company holds more than 50% investment. So obviously holding company controls the subsidiary company. But imagine, normally, at least in the Indian society, husband earns and puts the investment of more than 50% in his family income, family assets. But who controls? Wife. Now how does this happen? Because the controlling entity concept has to be there. And IFRS picked up, according to me, this concept from India, that subsidiary is husband. Subsidiary is the company who is getting controlled. Okay. You can see lots of girls smiling here because they are due for marriage. Alright. So subsidiaries are those which are controlled. And again, here to share with some of the experiences, control over financial and operating decisions. The body which takes the control over the decisions, who has the control over decisions, is the body should be called as holding company. And I am happy to see that the revised Schedule 6 has brought a concept of non-controlling interest, thereby accepting the funda of controlling entity over subsidiary. Now this was one of the major thing which was a gap between Ind AS and AS and IFRS interpretations. But now that revised schedule has accepted it, that is why I am able to make a bold statement that IFRS is equal to revised schedule 6 plus AS 30, 31, 32, barring some minor things. Let's put it this way. A Limited holds 90% in B. But A Limiteds have no control. There is another body, let's say C Limited, is controlling 10% and has right to all the decisions. How will the profits vary and who should consolidate? And IFRS says that B should be consolidated by C, okay, and not by A. And if you see the previous accounting standards, we had one way of controlling was more than 50% share capital. Another way of consolidating was majority of the directors can be appointed. Majority directors can be appointed by holding company. So, in many situations we have found that A company can be a subsidiary of B also as well as C also. Because C holds more than 50% and majority directors can be appointed by B. But the reality is different. The reality is that if there is some company D who has control, then that will be the holding company under the new rules. And that's where we will come across a situation in the real life where there are SPVs created to show that The actual controlling company is different, and on paper the company is different. And IFRS puts a stop to that. We all need to learn now the language like business combinations. Ind AS 103 has already adopted it. Mergers, acquisitions and reverse mergers. Let's start calling them business combinations. And the last is carrying amount and carrying value instead of WDV and book value. So this is a sort of a presentation for a layman, and this dictionary will help, I suppose, to all of us in order to see that how I can understand the IFRS in a very, very simple language. Get some water. Current assets include inventories and include the word trade receivables. How to manipulate trade receivables? Sorry, I will be using the word manipulate many, many times. Trade receivables were nicely manipulated. Are we all aware of there is an interesting tool called off balance sheet item. I think my Gujarati pronunciation is wrong. Off balance sheet items. All right. So if I have to talk about off balance sheet items, what does it mean? Simple. Let me give you an example. There was a company whose profit and loss account showed a revenue of 10,000 crores. Reliance taught me how to think big. Till coming to Reliance, I used to talk in lakhs. After working in Reliance, I learned I should never talk below 100 crores. And all costs were 8,000 crores. Profit after dividend, for simplicity, let me make it profit after dividend, was 2,000 crores. Now I'll show you the balance sheet of this company. Okay, let's take a next sheet. Balance sheet of this company. Now I'm trying still a horizontal form, which is no more permitted, but for understanding, this company has a PP or fixed assets, non-current assets. Non-current assets, current year, previous year. 6,000 crores and 5,000 crores. Current assets of 3,000 crores and 3,000 crores. Current liabilities and non-current liabilities of 6,000 crores and 6,000 crores. If you have to tally the balance sheet, this will be 2,000 crores and 3,000 crores. Very interesting. The profit is 2,000 crore after dividend, but the balance sheet has gone down only by 1,000 crore. How do I do that? I think many of you are in touch with Facebook with me, and I had published the business standard link 2 days back, which talks about one of the companies who has adjusted the R&D expenses against the compensation received from one of the foreign companies directly in the balance sheet. Okay. Without charging the expense and adjusting against some other income. So there are many window dressing ideas here which are nicely practiced. How are they practiced? The 6,000 crore